Today I got my friend Cody Touchette. He's hanging out. He's one of those super loan officers and super real estate investors. He's going to talk about what he's done and how you can do this too. Thank you, my friend Cody, coming and hanging out with me. This is Cody Touchette, loan officer extraordinaire. We've known each other quite a long time now, probably 15 years?
Yeah, at least.
12, somewhere in there. Longer than a decade. I've seen you grow in your business. I've seen your investment portfolio grow. So tell me, how long you been doing mortgages, and what's your business look like today?
You bet. So I've been in the mortgage business 23 and a half years. So in March will be my 24th year anniversary.
Awesome.
Crazy. Longer than I've done anything else, pretty much, right? What my business looks like right now, I mean, obviously we came through COVID. It was bonkers. Before COVID, we had our best year ever in 2019. In 2020, it doubled.
Wow.
And not like from oh, I'm just getting started and I had a big doubling, right? Like go from 10 million to 20 million. We went from 120 million funded to 240, it overnight, right? So we had to expand the team. We had to we were busting at the seams. It was a struggle. Now today's a struggle in a different way, right? I'll pick that 2020 struggle pretty much anytime compared to what we're doing now. But so then, the next year was even bigger. And then obviously things started changing in 2022, right? Interest rates, the Fed started raising rates, inflation was through the roof. And so we saw, pretty much a cut in half from the top of the business. And then this year probably is not quite a cut in half, but we will not beat our previous best years from COVID. So the goal next year, 2024, moving forward, is to beat that pre-COVID year, right? So we're going to beat 2019.
So you're basically coming back down to a baseline, reestablishing a foundation. Okay, hey, how do we grow from here?
That's right. Yep. Yeah. So we've got a number of partners, and we've got a great book of business, a bunch of past clients that we've nurtured and keep track of. And right now, a lot of those folks aren't moving because they're in mortgage lock, right? They've got 3% or less mortgages, and there's this big gap between their current mortgage and the new mortgage. It's like 4% or more, right? And so a lot of people feel stuck in their homes. So some of the things that we're doing to grow is getting the word out about maybe they're not as stuck as they think they are.
And so what have you, because the market's changed dramatically in the last 24 months, with the Fed, doing the fastest rate hike in history, definitely in our lifetimes. So what have you learned lately? What are you doing that's different from before, or what are you helping your clients with that's different?
Yeah, so I mean, there's a number of things, a couple things that pop into my mind. One is we're talking about tax savings a whole lot more than we have for the past few years, because rough numbers, married couple, standard deductions about $27,700, right? If you borrowed $600,000 at 3%, it's not exactly right, but simple interest, that's $18,000 a year in interest, right? And every year it's less and less. Maybe taxes are $9,000 or $10,000. They're $10,000, that's $28,000. The standard deduction is $27,700. So there's no itemization to be had. So buying a house at a 3% interest rate doesn't save you any money on taxes. In today's market, with 7.5% interest rate, there's a significant savings. I just did the math for somebody on a $600,000 loan at a 7.5% interest rate. Their tax savings, now this was a single person. So standard deductions like $13,350, I think it is. Yep. Their taxes and interest paid above the standard deduction was $40,000. So that $40,000 at a 22% tax rate saved them $9,000 plus per year in taxes.
Wow.
Broken down to monthly was about $750 a month. And so we were going through the math, and they said, well, that's great. I like that tax savings, but it doesn't help me pay the $5,000 a month bill, right? Yeah. I'm like, yeah, I get that. Now, how about if we change your W-4 with your employer? Change your W-4 with your employer, you can get more of your money that would otherwise go to the government, sit there for 12 months, and then you get a refund in April when you file your taxes. So we figured out a way to claim 2 more exemptions on his W-4, and that puts about $700 more in his pocket every month. So that is a huge change to what we would have been doing when rates were at 3% because it was negligible, right? There was no real benefit. The other thing that we do, we calculate backwards on that too, a tax affected interest rate, right?
Brilliant.
Think about that, right? So if the note rate is 7.5%, but then you get $750 a month back in tax savings. The tax adjusted interest rate on that is 5.62%.
Wow.
Yeah. So if somebody's feeling stuck at their 3.25% rate because it's 7.5%, well, maybe it's not really 7.5%, right? Because a tax equivalent 3.25% is equal to, for this person, was 5.62.
So you're literally helping them build a bridge, because the government doesn't care whether they get to keep the money or they have less deductions taken out of their paycheck.
Correct. Yeah. I mean, the government would love the interest-free loan for 12 months, right? So would I, right? Sign me up. But like, that's not what we want to do as taxpayers, right? You want to get as little refund as you possibly can, because that means you got your money in real time and you could do things with it, right? Whether it's invest or help offset the much higher mortgage payment than maybe what they thought they were comfortable with. And then the great news is when rates do come down, right? I don't know if it's 6, 12, 18 months. We all pretty much understand that they should be coming down with inflation coming down. Then you refinance and then you get back to a more normal spot. You still have some tax savings, but not as much as when you were paying 7.5% rate.
So thank you for teeing that up, because that's exactly where we're going next.
Yeah.
So in 2024, where do you see inflation going, and then where do you see interest rates? What's Cody's prediction for 2024? Yeah.
Well, so we just had some new results, right? The CPI and the PPI just came out yesterday and today, and they're better than expected measures, so that's good. Things are heading the right direction. Inflation has proven to be very sticky, right? So people were, getting government stimulus checks, they were getting raises, they were getting bonuses, because during COVID, a lot of industries were doing really well. Now that's subsided, right? There's some layoffs and people aren't doing quite as well there, but they have record credit and they're have these new spending habits and they don't really want to give it up, right? And so now they're going into debt to maintain their lifestyle. That will come to an end, right? And I hope it doesn't come to a disastrous end for most people, but there will come a point in time where it's like, oh, well, you better tighten the reins because the credit card bill is getting too high.
Yes.
For some people, it will be, we're bankrupt, right? And that's not fun. And that, I hope that doesn't happen for most of our, friends and family, but it's going to happen for some people if they don't change their spending habits and they keep going into debt to maintain their lifestyle. So why I bring that up is inflation, right? If people keep spending money, inflation's going to remain sticky or possibly even go back up. So right now we're around 4% for that core number, and it's kind of been hanging out there for a few months. I do think the next 6 months is going to be bringing a significant reduction in inflation, mainly because of housing. And so the Fed and the government calls it shelter. So shelter is roof over your head, but it's also the cost of rent increases, and it's also short term too. Like you go rent an Airbnb. If those prices go up, shelter costs go up. If those prices come down, shelter costs come down. So as we measure shelter right now is a 12-month average, and we can see it, right? We've got the past numbers to know that there's this big bell curve in shelter. And so at the peak of that bell curve was like 15% year over year growth.
And we all felt it.
Yeah, for sure, right? Rental renewals 7-8 months ago were going up 10, 15, 20%. Now they're back to 3, right? Which is back to earth, right? So if shelter's going up at 3% per year, right? 3% per year right now, but we're taking a 12-month average, including that 15% number. Right now, the average is about 7.5. And so if we get a few more months at 3, then we're going to see that number come down to 3. The shelter component of the overall inflation is 43%. So when we see that number go from 7 down to 3 in the next 6 months, I think, then you're going to see inflation just jump down over the next 6 months. So, because it is the biggest piece right now, food and energy and all these other things like durable goods, automobiles, they always add in, but shelter's the number one biggest component.
Yep. So shelter, 12-month rolling average, it's showing, it's like cars on a train. As each month rolls through, the one at the end comes off, the new car comes on. So we can see shelters moving in the right direction. Then what does that mean for interest rates for our home buyers, our home sellers, and our investors?
Yep. Well, the reason why interest rates have climbed is because the Fed has one tool to fight inflation, and they smack that sledgehammer on us every time inflation gets high, and it's the Fed funds rate, right?
Yep.
So when they raise the Fed funds rate, that's what their tool for calming inflation. And when they raise the Fed funds rate, it basically influences the cost of borrowing everything, right? So generally speaking, we see in past, like the last 20, 30 years, we see a correlation between the 10-year Treasury and the 30-year fixed rate mortgage, usually around 200 basis points. So if the 10-year Treasury is at 2%, mortgages would be 2% higher than that, right?
Yep.
4%, roughly. Yep. When COVID, when the rates started spiking up, right? We saw a spectacular rise in interest rates. Most mortgage companies said, hey, the loan officers like me, we make money when we originate loans, right? I help somebody buy a house, I get paid to do that work. The mortgage company doesn't really make a lot of money on that transaction. They make money on the servicing, the continued collection of payments.
Yep.
Or if they don't do servicing, they make money on servicing and release premiums when they sell that mortgage to another company that's going to collect payments. They generally speaking make 0.25% per year, right? So it's not a lot of money, but times billions, it adds up, right? And so they typically factor that those loans are going to stay on the books for 4 years. 4 years times 25 basis points is 1%. So when mortgage companies saw these rates spike up, knowing full well that they will come back down, right? We don't know when, but they will come back down. They said, these loans are not going to stay on our books for 4 years. We're not going to get our 1 basis point or 1 percentage point, the profit that we want, that we normally get over 4 years. So we need it right now. And so they raised the margins. And every mortgage company across the board did this. And so right now we see that spread between the 10-year and the 30-year fixed rate mortgage at about 300 basis points versus 200 basis points. So I think that you're going to see inflation come down.
Yep.
You're going to see treasuries come down. Mortgages will come down in tandem. And when mortgage companies see like, hey, this loan is going to stay on the books for a while.
For more than 4 years.
More than 4 years.
Yes.
They can then reduce that margin and say, okay, we can get our profit over the next 4 years instead of all right now. And some people say, well, gosh, if they're getting that margin now, why would they ever reduce it? Well, it's a free market. And there's competition. There's a ton of mortgage companies out there. They all did it because they all knew the same thing was going to happen. They're all going to pull back because they know the same thing is going to happen, right? Lender A, lender B, lender C, they're all going to come back to earth on that margin. So we're going to see kind of a double whammy good effect for clients and rates. We're going to see not only the 10-year Treasury come down because of inflation, but we're going to see the 30-year fixed rate come down from that. And we're going to see that margin compression. And I think we could absolutely see rates probably 2% lower than where they're at today in the next 18 months.
Wow. So I want to kind of boil this down. The lowering of inflation is the catalyst that then causes the Treasury to go down. And as the Treasury goes down, then we're talking the 5 or the 10-year, then the 30-year fixed debt goes down. And while that's happening, most likely due to competition, that's also going to cause that margin compression to happen.
That's right. Yep.
And so play this out as a hypothetical for me. So we get, let's say the Fed's done. They've paused. I've already won money from Benji multiple times. It's in the book right there.
Yes.
And there's going to be a new bet on the next episode because he won in Las Vegas at the slot machine before we stepped on.
You going to bet on how soon they're going to start lowering rates?
That's a good one. Note to self.
There you go.
So looking at that, because you pay attention, you're extremely just wicked smart at this stuff. And I get that you said over 18 months, but as interest rates, when do you think they tick out of the 7s? Because I think our local Seattle metro lights back on fire in the 6s.
6.99 and things get loose. Yeah.
Bingo. So, and I get it. Nobody knows. So this is, we're not holding you unless we're betting on it to these predictions. Is when do you think we pull into the 6s? What does that feel like today? And we realize there's a bunch of factors that could change.
Yeah. Went to a conference on Halloween.
Yep.
And before I left, we were tickling 8%, right? That was what we were like.
It was scary.
8%. I don't. And does 8 mean 9, right? And does 9 mean 10? Like, where is this going, right? There's a little bit of moment. And while I was gone at that conference, well, we talked about this, right? There was maybe a little bit of dirty pool with some hedge funds, but there was some impetus in the market to drop like 0.5% in 8 days time.
Yeah.
Right. And now yesterday with the CPI numbers, we gained another 50 to 60 basis points in mortgage-backed securities, which equates to another maybe eighth to quarter.
Yeah.
So from 2 weeks ago, 8% worrying about, do we go to 9? Now we're at like 7.25.
Yeah.
Right. That's the move. That's how quick it can happen. So if the CPI numbers keep going the right way, the Fed's going to come out this week and they're going to talk tough, because what else do they do? Right.
They've got to use their mouthpiece to stand on us with the boot on the neck and be like, everything's bad.
Because they know they can't raise them again.
Bingo.
They have to talk tough because they can't raise them again. Right. So, and they shouldn't, right? Arguably they shouldn't have done the last 2 moves, right? It's probably already too much. But that's why we think they'll probably start moving again in March. Is aggressive. I think May is probably when they start to lower those rates. And if you go back and you look at the Fed funds history, go back as far as you can, you will see lots of these times where in the 80s it was a bit of lengthy, but since then monetary policy's changed a bit. Usually when there's a big spike up, there's a big drop off. Big spike up, big drop off. So what they do is they use their hammer and they hammer down the problem. And they get it right, and then they throw the hammer away, right? And they say, okay, we're done with that, right? And they take it back, And so because they want growth, right? And that's the thing, like, it's so funny, the stock market really reacted to this really, really low CPI number on Monday. And it's like, hooray, the economy stopped growing. Yeah. I'm like, wait a second, like now we're going to invest in stocks because the economy stopped growing? Well, it's because now money's going to get cheaper for businesses. And when money's cheaper for businesses, they can grow again, right? So we get back, it's a cycle. It's all a cycle.
So you mentioned, and this was a phenomenal offline conversation, but I'd love to get just a brief snippet of it. What was the dirty pool that the hedge funds were playing that essentially their bet, worked out or didn't work out, and then caused that first interest rate drop? Walk us through that.
Yeah. Well, it's basically it was a short position, right? So you think about like the times during COVID when we were all in our basements trading stocks or trying to make our way through, the Wall Street bets guys, right? And the AMC and the GameStop, right? So there was these hedge funds out there that had bet against these companies, saying that they're going to fail or their price is going to go way down, right? And so there was a hedge fund that basically took this same position with Treasuries, right? With MBS, like mortgage-backed securities and Treasuries. And so they thought, okay, hey, we're going to keep pushing this. And they got to the point where the time was up and they had to cover their short positions. So they had to go out and buy. And when you have to buy, regardless of the price goes up. Yes. And those hedge fund guys, they don't dink around, right? Like they're not doing this with a couple $1,000,000, right? This is billions of dollars. And so they had to, and that's the thing, like mortgage-backed securities, Treasuries, even stocks, it's supply and demand.
Yep.
If there's so much of the stuff available and there's only a few buyers, well, the price is going to go down. If there's not so much of it available and there's mountains of appetite and the people want to buy it, well, the price goes up.
Yeah.
Right. And that was how we corrected our problem as we went into COVID. Because I don't know if you remember, but in 2000, like early 2020, rates were getting pretty good.
Yeah.
We were in the low 4s, maybe even high 3s. And like, it was like, okay, it's on, right? Refi boom. Like, let's go refinance all those high 4s and low 5s into high 3s. And then COVID hit. And we shut down for a couple of weeks, right? Nobody knew what to do. We wore our masks. We hoarded our toilet paper, right? We did the things that we had to do, right? I remember going to the grocery store with like gloves on and a mask on and not knowing, like, don't touch anybody, right? Yeah. Like it was very nervous times. And so all of a sudden, nobody was buying mortgage-backed securities, right? And by the way, we had just been issuing a bunch of them. So we'd issued a bunch of mortgages in January and February. And then in March, we're like, okay, market, here's these big pile of securities we'd issued for 30 years. And now the traders are like, ooh, I don't think I want something that's 30 years. Like, I don't know what COVID's going to bring.
Yeah. Did
we have a 12% mortality rate, right? Are these people going to be around to pay mortgages? Like legit, like that's what they were thinking. Like, it sounds awful, but like, are people going to be here to pay mortgage? Are we going to need as many houses that we have built because we're going to lose people, right? Yeah. Like that was, and so they're like, no thanks. And so for several weeks, we had no appetite. And so when you have no appetite for the good and there's lots of the good, well, the price falls. And when prices in the MBS market, mortgage-backed securities market, when prices fall, the rate goes up. We went from high 3s to 8 in 2 weeks.
Oh my.
but nobody necessarily knew it because it happened so fast.
Yeah.
And and around that time, there was only the people that were in contract in February trying to close in March. Because once COVID hit, like everybody's like, oh, I'm not looking for a house right now.
No. Real estate stopped.
Everything stopped, right? But what we already had in the pipeline didn't stop.
Yes.
And anybody that hadn't locked was like, wait a second, what? Like legitimately it was going up 1/4 to 0.5% a day in over a 2-week period of time. It was bonkers. And so like the mortgage industry, real estate, like we all lobbied the government like, hey, you got to do something about this. We need liquidity. We've issued all these mortgages. There's no place for them to go. Literally, we're going to grind to a halt. And so they stepped in and they said, oh, okay, well, we don't really want to do this, but we're going to buy a certain amount of mortgage-backed securities and a certain amount of treasuries.
Yep.
And they opened up the checkbook this much. And the money was gone in 3 days. And so rates went down, and then they ran out of money and rates spiked back up again. And so the next week, Monday, the government was like, okay, we get it. You need more. And so then they basically opened up the checkbook. That's when we saw rates fall and, we got into the 2s and 3s. So that supply and demand is very real in our marketplace. And so that hedge fund that was the demand, and really there wasn't a whole lot of other demand, but they were the demand. And be honest, we haven't been issuing a whole lot of mortgages lately, right? Like less than ever. So now there's this massive amount of demand for people that have to cover a short position. They don't have a choice. They must buy, and there's not a whole lot to buy. So if you got mortgages on the shelf and this guy's offering some huge premium, you're like, okay, I'll sell you some, right? Yeah. And it just keeps going up, right? Yep. And so that continual increase in the price drove the rates down. And so, I don't know if there's more shoes to drop there. I mean, who knows? Maybe they weren't the only one that made that play.
I didn't think about that because there's never just one player in Wall Street.
Those guys talk.
Yeah, exactly. They're sitting around having cocktails. Hey, you know what we just did? And someone goes, oh my, we should do that too.
Yeah. Word gets out and the smart guy's the first one in, and okay, well, I'm gonna jump on that trade too.
Well, and a lot of that, there's no way to stop it from being public record.
Correct.
So some of it you can hide for like a period of time, but like after that, everyone figures it out. Okay, I want to switch gears. I want to go over to the investor side. So you are a super investor.
Super investor. I like that title.
Yeah, you get a little title, a little cape. And I want to talk through real quick for the audience, like what was actually, let's go first. What's your portfolio look like right now so we can kind of establish that? How long have you been an investor?
Sure. Well, so I bought my first house when I was like just out of college. So like 23, I think. And honestly, that's when I view my start as an investor.
Oh, right? I love it.
Because that's when I bought my first house. And I did end up turning that one into a rental as I bought my next house, right? Which I think is the most phenomenal way to get started. But so I guess from 23, so over 20 years. But like when I first got like real serious about it this go round, right? Because I ended up selling that house and I was like, I'm done with renters because it didn't go super well, right?
Yeah.
But then really like my investing journey this go round, this lifetime, if you will, started during the collapse, right? So in the mortgage meltdown in 2006, 7, 8, around 2007, I said, hey, we used to do about 10 loans a month, and now we're doing like 1 loan a month. So I got to find some way to bridge the gap, right? Yeah. And so it just so happened that, unfortunately, there was a lot of foreclosure and short sale activity. People got in over their heads with subprime loans, and watch the Big Short if you haven't seen it. It explains it very well, very, very entertainingly. But like we jumped into that market because I had extra time and I needed to bridge the gap. So I started helping other people buy foreclosures and short sales at the auction and thought, shoot, I could do that, right? Yeah. And I got a little nest egg. I can get going on this. So I started by buying at foreclosure auction and flipping, right? So I would buy a house for $200,000, put 50 into it, and hope to sell it for 3.25, right? Make a couple bucks, pay some real estate commissions, have a project, something else to do, right? Because 1 loan a month didn't take up a lot of time. So, that was where we started. And then around 2011, it became pretty clear. Well, one, the hedge funds came to town, right? And they were scooping up everything. But then it was pretty clear, like, it looks like we've bottomed, right? The homebuyer tax credit came out. Rates were getting better. We'd sopped up a lot of that 6 to 12 months worth of inventory that was on the market. We'd gone through the shadow inventory in the banks. So it was pretty clear we were turning a corner. And that's when I said, actually, I had a flip. you gave me the renter for it. It was a flip in Marysville.
Oh yeah.
And it wasn't going to be a very good flip,
Yeah.
but I was pressing the boundaries because we had capital we had to put to work. And so I bought this place, and I think I was going to make like $13,000 on the flip.
Yep.
And I chatted with you, and I said, man, I don't like, this thing isn't a very good flip, but like, who do you know? What should we do? And you said, well, hey, I think I got somebody that might want to rent that.
Yeah.
And one of your buddies
Yep.
said, yeah, I'd rent that. Are you okay with this, that, and the other? I was like, yeah, that's fine. Brought in a couple buddies. They rented this house for $2,000 a month,
Yeah.
and it made me $500 a month, net.
Perfect.
So I'm thinking, okay, I could make $13,000 one time, pay taxes on it, right?
Yep.
At regular tax income rates because, I didn't own it for over a year. And I could do that. Or I could make $6,000 a year in perpetuity and retain the asset.
Yeah.
Ding, 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 right? I was like, okay, I got to do that, right? Like, I'm going to keep this and rent it. So then we started looking at the auction a whole different way, right? Auctions, short sales. We're like, okay, what can I get this for? What do I need to do to fix it up to rent, right? Because that was the other thing. When you fixed up a flip in 2008, it had to be the best dang house on the market, right? And you had to be under the next best guy on the market because every month home prices were going down 1%.
Yeah.
So if you listed it on, January 1st, if you weren't sold by February 1st, it's worth less. And you're going to have to reduce your price, not only the amount that the market's gone down, but now you got to be lower too, because if you had the price right in January, it would have sold. Right. So for me, that was when I got my start, like in this lifetime of investing. Was 2011. I started buying and holding. Right. So I'd buy them, fix them up, put them into rental service. So I started buying some off market stuff, buying some foreclosure stuff. And then we got to, I think it was probably around 2018. I had like 26 rental units in Western Washington, feeling pretty good about myself.
That's gangster.
Right?
Yeah.
Yeah, I was doing pretty good. And then, they were doing okay. But then we got to the point where the value started to really rise, but the rents weren't really rising.
Yep.
Right. And so then one of my favorite calculations for my portfolio, and this is really, really good, you got to take notes on this, is return on equity. Right. When we're buying an investment, we talk about return on investment. And I had calculated my return on investment. But if I only put $50,000 into a house and it was making me $10,000 a year, that's a really good return on investment.
Yes. Your cash on cash is crazy.
Exactly. But if now that property's gone up in value and I still make $10,000 a year, but it's got $300,000 worth of equity in it, now my return on equity is garbage.
Garbage.
3% ish, right? So I go from making 20% to making 3%, that's time to repurpose, right? That's time to do a 1031 exchange, move that money to the next property. The other thing is maybe that's a $500,000 house that I got $300,000 in equity in. If it goes up 10%, I earn $50,000, right? The market appreciation. But if I've got $300,000 in equity and I could leverage that at 4 times with 25% down, I could buy a $1.2 million property. So I sell my $500,000 house to buy a $1.2 million property. Now, if the market goes up 10%, I earn $120,000 instead of $50,000.
Ding.
Right. And so then, like, that was what I was looking at. Okay, all my properties in Western Washington, they've been good rentals. They were known quantities. They made money every month. I've owned them for years, but they're not really serving my ultimate goal. So at that point in time, we started looking again, like, okay, where do I repurpose? And it just wasn't Washington, right? And so for me, we ended up looking at some out-of-state investments. So started with Oklahoma, went to Tennessee, then we've got some in Idaho and Arizona and Milwaukee, Wisconsin, and Minneapolis, Minnesota. So now the portfolio is 128 rental doors. That's 22 different properties in 7 different states.
Wow. Okay, there's a lot to unpack there. So the catalyst was return on equity.
Yes.
And now I'm looking for a better return, which causes me to go out of state. How do you deal with out-of-state management, multiple states, multiple banking, multiple entities, property management?
Yeah.
And then what also, when you did that, because we know our Seattle Metro is we're a high appreciation, low cash flow market.
Yep.
What changed there too?
Yeah, no, great question. So I guess let's start with the last one is I started thinking about, I want to have cash flow for retirement.
Yep.
And appreciation is great. But we also learned in that downturn in 2006, 7, 8, and we learned last year that appreciation is not guaranteed.
Yep.
Right. If you hold it long enough, it will go up. Right. But like having a regular, predictable cash flow was what my personal goal was. Everybody's different, right? If somebody says, hey, that's silly, I want to buy where I live and I want to be able to double my value in 5 years and have that be my income, cool. Right? Like that's great. Like to each his own. Like there's many different ways to get rich in real estate, but most of them are get rich slow, right? Like that's what I like to say. This is real estate's a get rich slow scheme, right? Like it's not a get rich quick scheme, right? Like that's BS, right? That could you kill it with some flips here and there with great buys? Absolutely. But like if you want to really get rich, it takes time. Right. So the appreciation levels in some of these other places where I've bought are, they range between 2 and 10%.
Yep.
Right. And at 2%, that's not exciting. But if I can make a 12% cash on cash return, still get 2%, still get the principal pay down and get the depreciation of a much bigger building, it really adds up.
Yeah.
Right. As far as how we manage it. Right. I mean, every property I own, whether it's down the street from my house or, 10 states away, they're all managed by a professional, right? I liken it to having a car, right? If somebody said, hey, Cody, you can have a car. It's all going to be awesome, but you're going to have to change the oil. I might say, well, I don't know how to change the oil. Maybe I'll pass, right? Yeah. And so I talk to a lot of people that say, well, I don't want to deal with the middle of the night phone calls. I don't want to deal with the headaches, the leaky roof, the leaky toilet, blah, blah, blah. I don't either. I don't. I'm a property owner. I have somebody I pay to be the landlord, right? I'm not a landlord. I'm a property owner. I'm a businessman, right? So I don't deal with those things. So having a great property manager in each one of those areas is key. And then aligning yourself with people that have similar goals, aligning yourself with real estate agents that know and understand that market that you want to go into, and then really getting an understanding of the market that you want to go into too, right? Each one of these markets was determined and researched by somebody that I really trust, right? So Jennifer Beadle started a company called Addicted to ROI, Agents Invest for the agent side. And they go out and they investigate all these marketplaces and they do the due diligence for me because I'm a pretty busy guy, right? And if I had time and I was retired and I wanted to do all that sort of work myself, I could do it. But right now I'm better served closing loans, helping our clients get to where they want to go. And they do the research for me. Right. So I get pre-scrubbed deals. I get predetermined things that I know will make sense, do my own math and execute if it's right.
So you left the high appreciation, low cash flow market and you went from 26 to how many units?
128 units.
So you basically added 100 units.
Yeah.
What happened to the cash flow position because you can't eat appreciation?
Correct. Yeah. It's hard to buy groceries with appreciation. Yeah, exactly. So yeah, cash flow is off the charts, right? So like these properties you can buy for, 70, 80,000 a unit and they rent for $1,000 a month, right? I've got a property that I bought in Clarksville, Tennessee for $2.4 million, dramatically under rented, like the management was no good. That brings in gross rents now of like $47,000.
Wow.
Yeah. When I bought it, it was like $25,000. So we were able to go in, like I love value add, right? That's my jam, right? Is if I can't value add, then I typically won't buy it. There was one exception and it was actually two. There was brand new construction fourplexes in Clarksville. I was doing the research on the financing for that Clarksville 42 unit property. And the banker said, hey, do you have appetite for more? And I was like, always, yes. What do you got? And so he had a developer that they were doing financing for, building I think it was a dozen fourplexes that, land he bought and subdivided and did all the things. And he was building 12 of these things. And he found a bigger, better project that he wanted to get into. He was going to hold them, refinance them, but he wanted to move on and do something different. And I said, well, yeah, tell me about it. And he said, fourplex, $500,000, projected rent is $1,250 a unit.
Ooh.
Brand new roof. I mean, like literally ground up construction. So I'm not going to touch the hot water tanks forever. I'm not going to touch the AC, the furnace, none of those things, right? Roof's good for a long time. Brand new 1% rural property.
Perfect.
And Clarksville at the time was a really highly appreciating area, metro, because it was just having so much growth. In 2019, it was voted the #1 city to live in the country.
Yeah.
right? Like very, very popular. Huge military base just north of where my properties are, right? So brand new construction, 1% rule, absolute cash machine. That thing throws off $1,500 a month every month right now.
I'll take 20, please.
I know. I bought 2. I wish I would have bought them all, but we were in contract to buy the other one. But since I bought a couple more in that area, and then we did something similar in Idaho, there was a guy that was building a whole neighborhood of duplexes.
Yep.
And for whatever reason, God love him, like he wanted to sell them before they were built. I said, yes, please. And I was late to the party, but I got one, right? And so I got one, and some of our other investor friends got 1 or 2 each. But like we set the price before he broke ground. $360, I think $330 is what I paid. Most people were paying $360 because theirs were a little bigger. I got the runt of the litter, if you will. But at $330, it appraised at $480 18 months later when it was done. And I put in a deposit for like 30 grand.
Yeah.
Right? Done and done. Right.
Yeah.
So
30 turned into 150 over an 18-month run before the building was even built.
Correct. And it cash flows at $1,200 a month on a $330,000 purchase. Right. Perfect. So yeah, I mean, like, so those are the 2 examples of where I've bought non-value add, but like you might say I value added my own way, right? Like being able to buy pre-construction was a value add moment, right? The new construction, zero maintenance, management, I pay management of course, but zero maintenance, like no CapEx for 10 years probably.
Yep.
Right? We have a unit turn, it's like wipe down the walls and they're all LVP, right? So like it's very simple unit turns. And people don't turn because it's brand new.
Yes.
Right? So
where do you see the best real estate investment opportunities over the next 12 months? What are you looking for?
Yeah, that's a great question. So I actually had gone away from this highly appreciating market, the local market.
Yep.
I think we're back.
Ooh.
Right? And the reason why is things have come down, right? The higher interest rates have put price pressure on buildings. I think you can get a deal right now in the Pacific Northwest. And as rates come down, those prices are just going to shoot back up. So I would be looking personally, I mean, I still like the Midwest and I'm a deal hunter out there as well, but I'm personally looking for value add properties in the Pacific Northwest, specifically places where you can build an ADU or a DADU in the backyard or even the front yard, right? I looked at a house the other day where it had the small house already in the back of the lot. And I was like, why did we build a big house in the front and call the existing house a DADU?
Brilliant.
Right?
Brilliant.
So we can build a 3,000 square foot normal regular house in the front and then carve off and sell the second home in the back, right? So I think that's a really great opportunity. Personally, I would focus on like the more metro areas, right? The shoreline, Seattle, Kirkland. The numbers are bigger, which can be a little more scary, but the numbers are bigger on the exit too, right? Like you can build a DADU for $325, right? 1,000 square foot for $325,000. I did one in Olympia. A $300,000 DADU build is worth $400 when you're done.
Yeah.
A $300,000 DADU build in Green Lake is worth $750 when you're done.
Yes.
It's the same amount of work. It's the same amount of hassle. It's the same amount of money out. But because the dirt's so much more valuable, you've got so much more added equity. Now, then the question is, do you sell it or do you refinance and keep it? Right?
Yeah.
And I think you could ring the register, but if we think rates are coming down and you can rent it because you're into them so low, right? You've got such a great dollar cost average for the overall project. If you could rent it and break even, maybe make a couple of bucks, rates come down, you refinance, now you're making real bucks, rates come down, values spike up. I think there's an opportunity to make $500,000-$600,000 on each one of those DADU plays in Seattle, Kirkland, Bellevue.
Sign me up. Let's go.
Let's go.
What has been your worst investment?
Yeah, super fun question. I love reliving these. Yeah, so honestly, it was my first property I bought in Oklahoma City. It was a 18-unit apartment complex that I did not go see before I bought it. I bought it for $550. Seemed like a bargain, right? Compared to Seattle numbers. Rents were $6,000 a month between 18 units. Sounded great, right? 1% rule better. Books were cooked.
Oh.
knows every tenant there either wasn't paying or had some sort of side agreement with the other guy, right? And so when I hired a property manager. When I hired them, she went out there. The first one quit, first time. Right. First look at the
shows
property.
up, looks down, looks at the property. It was like, okay, it's over.
Nope, not doing it. She said, I think I've got just the right manager for you. And I was like, okay, please help. Right. And so I called this gal and she's like, yeah, we can handle it. Right. And so the first couple times through the property, they get chased off. They find out, well, I was only paying $200 a month and blah, 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 lets me deal drugs. And I was like, whoa, no.
Yeah,
right. So within 2 months owning that thing, we had the gamut. Right. Police called, drugs, prostitution, gang, and domestic violence. Like the 4 things you just love to see in a rental property, right?
Wow.
And so, yeah, just like absolute pandemonium. Like calls every day. I was like, oh my gosh, what did I get myself into? If I'd just flown out there, I would have never bought it.
Oh, got it.
Right? And so I thought, okay, I'm going to be the out-of-state investor that doesn't have to set eyes on every single property. Well, that was stupid, right? Now, I'll buy a brand new duplex in Idaho without seeing it. That's no problem.
Yeah, it's different.
When I bought that 24 unit or the 42 unit in Clarksville, we flew out there. We took a look at it. We put eyes on all but 8 of the units.
Yeah.
Right. So didn't see it. No, the books were totally cooked. It was we had to fully vacate the property. There was one guy that stayed, retired Army guy, and he's like, I'll keep an eye on things. And I was like, your rent's free, sir. Thank you. Right. Like, so 0 revenue. And then things got worse as they went by, right? Appliance shortages. The contractor guy clearly wasn't his main focus, right? Like, well, I kept pounding. We were into that renovation for 9 months. Wow. No revenue.
Oh, wow.
Right? Yeah. And meanwhile, $450,000 mortgage payment, right?
Yes.
So like, I don't know, $3-4 grand a month. So I'm just like, and by the way, a $300,000 renovation. So just spraying money, right? I was like, make it rain. In the end, we could not get it stabilized and right? I finally got there was a 6-unit building on one street and a 12-unit building on the other. We were able to get the 12 pretty full. The 6 took forever. We finally got it full, and I was like, okay, I'm done. Like, I'm not going to do this anymore. So we put it up for sale, and I got an offer pretty like we just fire sold it, right? I got an offer pretty close right away, and then we moved. But basically, I sold it for what I was into it for.
Yeah.
Right? And so I literally made no money on that deal.
Over what time period?
Over 2.5 years.
Okay, got it.
Yeah.
Wow.
We made a couple bucks on cash flow, right?
Yep.
We did get it to the point where I was making maybe $1,000,
Yep.
$1,500 a month in cash flow, but only for the last 6 months. So I tied up $400,000+ over 2.5 years. I'd have been better in Treasuries.
Yes.
I'd have been better in a CD probably, right? Way less calls on the phone. But what that afforded me to do is I sold that property and I bought probably my best investment with the proceeds of that sale.
Oh, wow.
I traded 18 troublesome doors in Oklahoma City that brought me no joy to a luxury vacation rental in Scottsdale, Arizona.
Perfect.
Yeah. So I got something I really wanted, something I can use as well. And it's luxury. So I feel like it's, and knock on wood, it's been relatively insulated from any sort of downturn economically. Where a lot of people that are in short-term rentals right now are struggling. Right? Because there's a ton, again, inventory price, right? There's a ton of people that went out and bought second homes to turn them into short-term rentals over COVID and coming out of COVID because they heard their friends were doing it. And it was really good. It was very profitable. But now we've got a ton of supply and less people on vacation. So what happens to prices? They come down.
They go down.
Right. And so when your prices come down, your revenue comes down, and pretty soon now you're not making your mortgage payment, right? So that vacation rental in Scottsdale, though, is luxury. It is an oasis. Like, it's the place. Pool, hot tub, putting green, sports court in the back with pickleball and basketball, 5 bedrooms, sleeps 20. Like, it's spectacular, right? And we actually, last year, we had a baseball player stay for all of spring training.
Awesome.
So you hope to get your weeks and weekends booked in spring training by probably 5 different groups, right? We got one group. Ring the register. That one payment was 10 months worth of mortgage payments.
Perfect.
Then we lucked out and had the Super Bowl last year as well.
Yep.
That one booking was 6 months worth of payments, right? So in those 2, We covered more than the year, and everything else for the whole year was gravy.
Awesome.
Got another booking for a baseball player for next spring training. Doesn't even start until February. Already booked.
Perfect.
Already booked and paid. Paid in full.
Perfect.
Yeah. So that terrible investment led its way to me being able to make arguably my best investment. Yeah.
That's awesome. What did you learn? What changed in your process? And, what are you going to do different in the future?
So I did learn, like, boots on the ground is so, so important, right? Like, whether it's my own boots or somebody I really like and trust. The boots on the ground in Oklahoma, I couldn't trust them, right? They were not trustworthy. I was just a guy trying to make a commission, basically. So due diligence on your boots in the ground, whether it's all of the above, right? Real estate agent, property manager, inspector, and then making sure that your property manager has all the ancillary services as well, right? Plumber, electrician, regular handyman, regular services, that sort of thing. I learned that I gotta set eyes on something that's over $1 million. That's my new rule.
Perfect.
Right? If it's over $1 million, I gotta go there. If it's under $1 million, I gotta really do the due diligence on the people that are on the ground there. The other thing that I learned from that too was it's really important to have critical mass in an area, right? So if you have 1 or 2 rental properties in an area that's out of town, you might be able to luck out and find a great property manager. When you have 50 units, you can hire the best property manager in town because they want you.
Because they're going to pay attention.
Correct. Yep. And that's what we had to do. So in Oklahoma, I also have a 37 unit apartment complex there that we've kept, and it's been tenuous, right? And so we just recently changed mortgage management companies. The gal that was there, she wanted to do it for 5%. And 5% is relatively low from a management perspective, unless you're up to like 100 units. So at 37, I was like, are you like this? Like, I want to make sure that this is a priority. And they promised it would be, and it clearly wasn't. Like, reports were always late. I was having to like, hey, where's my money? Like it's the 15th of the month, all rents should be due and are there. I would get my rents the next 15th, right? They were 45 days behind giving me rents for when the first of the month was.
Ooh.
Right. And I would be pulling teeth to get reports out. So I called one of my brethren, somebody that works in the mortgage business, is in the core in the area. I was like, hey, I need a new PM. Who do you got? He connected me with this gal. They've been excellent. And for their first time through, they got chased off the property. They had to call the cops. There was some suspicious activity going on at the property, right? So like, I hate to say it, but like these properties were getting out of control because the management wasn't good.
Yeah.
So really good property management is key. The property in Oklahoma or in Tennessee, I flew out and we walked the property with the property manager that was going to manage the units. And I got to see how she interacted with the tenants, how she took cockroaches, how she took kids with no beds, how she took like not great tenants. And it was awesome to see, right? I was like, this is the person I need running the property.
That's awesome.
Yeah.
If you were to start all over again and you had to just start all the way over, or you're, 23 years ago starting over, what would you do differently building your portfolio this time?
Yeah. So if I were to start all over 23 years ago, have no rental properties, what would I do to start over? I mean, number one, I think the best way for somebody to get started is a very low down payment, owner occupied property, multifamily, if you can handle it. Right. So if it was me 23 years ago, I don't have any kids, so I wouldn't have had any kids 23 years ago either. With no children, and this isn't a requirement, but like no children, you need less space, right? You're more flexible. I would buy a fourplex, owner occupied, with either an FHA loan, or now, as of Monday, we can use a conventional loan with 5% down on an owner occupied fourplex. Okay.
Wow.
That just changed. Literally, it's not in effect. It changed a couple months, maybe a month or so ago, but it goes into effect on the 18th, which is Saturday. So Monday, the 20th, that's when we can start closing these. So that would be my absolute first way to get started, would be owner occupied, 5% down, conventional fourplex, live there for a year, and then see if I could do it again, right? It's a little tough to get sneak that past underwriting a second fourplex. Like, oh yeah, I'm really going to live in this, right? Like but that's the letter of the law, right? That's what Fannie Freddie's that says you can do. So I would go do it again, and I would go do it again, right? If you could do that 10 times, own 10 fourplexes and then go buy your new single family primary residence that you want to raise your family in, lights out. Like, you're done.
Done.
You never have to invest another dollar.
Yeah, no, you would literally just destroy it. That was the formula to be a multi-millionaire in less than a decade.
Yes.
Golden. Okay, now let's flip this around. Now you have all the wisdom, you have the knowledge, but we took away your resources. All of a sudden, Cody has no cash and all of his rentals are gone. He has to rebuild everything tomorrow. What does he do?
Man, if I lost everything,
Yep.
no dollars in my pocket, all the knowledge, but none of the resources, right? What would I do to start over? I mean, obviously that is still something I would want to do, but I think what I would do is I'd start hustling and I'd go find properties that need a buyer. And if I can't be the buyer, I'd find the buyers, right? I would probably wholesale to get going again, right? I would find a property that I could get at one price and sell it to somebody else for another, or make a small commission along the way. I would wholesale to build up capital, then be able to start buying and holding properties. And really the best way to get going on buying and holding properties is low down or zero down primary residence, turn that into a rental a year later.
Stack up your 10, win again.
Stack up your 10. Yeah. And that 10 is for Fannie Mae, Freddie Mac finance properties too, right? And it doesn't include primary residences. So if you bought 10 owner occupied fourplexes over the next 10 years, and then you bought a new single family residence, you could then go buy another single family residence, keep that 11th property and buy a 12th property with Fannie Mae and Freddie Mac. They're okay with that. The new one just has to be primary. They won't give you a 11th rental property.
Any final thoughts?
Yeah, I was thinking about this, and this is I brought this special for you because you'll see it at the end. Why? And it's like thinking about, and this works for all kinds of categories, whether it's business or personal, but it's thinking about 100 pennies and 4 quarters. Do they spend the same?
100% they do. Yeah.
Of course. Yeah, they're the same, right? 100 pennies spends the same as 4 quarters. Now I want you to think about stacking them up on the table and picking them up in your hand. So you got 100 pennies in your left hand and 4 quarters in your right hand. Do they feel the same?
No.
They don't feel the same. Now put those pennies and quarters in your pocket and walk around all day. I want you to think about the weight of those 100 pennies in your left pocket. And you're like, oh my gosh, my left leg is just sore. Now what I want you to think about is, where are you carrying around 100 pennies in place of where you could have 4 quarters?
Boom.
And where that comes from, and this is why it's for you, my friend, is that where that comes from? It's a famous quote that I'd rather have, it says, be careful who your friends are.
Yes.
I'd rather have 4 quarters than 100 pennies.
Yes.
You know who said it?
No.
The original gangster, Al Capone.
That was gangster. Good job, Cody. Pleasure having you. Everyone, like, subscribe, comment. Thank you.
Thank you.